Okay, cool. All right, those that are starting to watch this live stream, give me just a second. I want to make sure everything is running smoothly on all the appropriate accounts. It looks like it is. By the way, for those that have been watching these live streams, I got a brand new camera last night. We're going to see if that improves the quality. You can hear me actually testing it. So appreciate those that watch this. There should be a good conversation with Mr. Rory Johnston, who I had on a space a while ago. This conversation is on behalf of the ETF think tank at Title Financial Group. Title Financial Group helps bring ETFs to market. So if you're a financial advisor and curious about what it takes to bring a fund to market, Title is the company to go to. I'm excited for this conversation because there's a lot going on in the oil market. And I think it's important in the context of this reverse carry trade thesis I have, which people are maybe now questioning given the market's reaction today. We talk about oil because oil is a critical component of that. So with all that said, my name is Michael Gayed. In this capacity, I'm a member of the ETF think tank at Title Financial Group. I want to have my friend, Mr. David Chikansky, introduce himself. So David, go ahead.
How's it going, everyone? David Chikansky. Excited to be back with the show. I am the CEO and CIO of Quantified Funds, soon to be issuer launching on Title's Trust. Very excited to be here with Rory Johnston, who you can find at commoditycontext.com. Rory, why don't you jump right in, introduce yourself, talk about a little bit about your history and what brought you to where you are today in the commodities world.
Thanks so much for having me, Michael and David. So as David was just saying, my name is Rory Johnston. I'm the founder of Commodity Context, an independent oil research platform. Prior to this, I worked very briefly with a family office, but most of my time was spent leading commodity economics research at Scotiabank here in Toronto. So I'm Toronto-based, I'm Canadian, and at Scotiabank, I covered all commodities, and I really wanted to focus in more on crude oil specifically, and this has kind of allowed me the opportunity to do that. And thankfully, the market has been sufficiently interesting over the past 2-3 years to really keep me busy. So I'm thankful that I can do this, and let's talk crude.
All right, so I'll start off. Last 2-3 years. How about the last 2-3 weeks? Because there's been a lot of interesting movement. Where are we with global demand for oil, broadly speaking, and in terms of just in general how the supply dynamics look entering the end of the year?
Yeah, so one of the big dynamics that's playing out this year so far is that demand growth is slowing. Last year, demand growth was really strong, led by China. China alone accounted for more than 80, potentially even 90% of global liquids demand last year. It was, by all kind of indicators, one of arguably the strongest single year of liquids demand growth in the history of the oil market from China last year. Now, it was coming off of a weak base effect with COVID-0, but regardless, it was an astronomically strong year, and particularly a really, really strong second half of the year. The challenge, however, is that sets up a really, really high bar to beat again this year. And what we've seen is really starting in April into May and now June is it appears that Chinese oil demand is now in contraction. So going from driving global oil demand to now a net drag on global oil demand. Now, it's still possible that China will reaccelerate and kind of lift out of negative territory. I think that is the base case expectation for the balance of the year. But you need to really rip higher in order to actually show any meaningful growth. And without Chinese growth, it's really, really hard to reach a really, really high oil demand number. Like the bullish people in the market right now are kind of looking at 1.5 to 2 million barrels a day of demand growth. OPEC's own official forecast for the year is 2.25 million barrels a day of demand growth, whereas the IEA and EIA are down nearer 1 million barrels a day of demand growth. And right now, we're kind of trending towards that latter group, that kind of million barrel a day group. Obviously, everything can kind of change in the second half. It did last year, but that's the kind of situation. And supply, while demand has been decelerating, supply has remained more or less steady. You've seen U.S. demand growth, U.S. supply growth slow materially from last year, which it was also a big surprise. It doubled the initial expectation of growth last year and printed about 1.5 million barrels a day of growth on the U.S. supply side. But so that's slowing, but you're also seeing a couple areas, particularly outside of OPEC, accelerate, most notably Canada right now. Canada is going to be one of the largest contributors of global growth this year on the supply side, following the completion of the Trans Mountain Pipeline, adding 2, 3, maybe even 3.5, 3,500,000 barrels a day of growth. adding that to Guyana and Brazil, which are each going to put up impressive numbers kind of year over year for the next little while. So you've got a structural kind of slow moving supply growth out of Brazil, Guyana, and Canada. You have a price sensitive growth that keeps surprising to the upside, maybe this year, maybe not, but has historically surprised to the upside in the United States. And essentially OPEC hoping for global oil demand growth to give it room to begin easing its record kind of, or not record, but crisis level production cuts and support for the market. Excluding the COVID cut, this is the largest amount of production cuts and support that OPEC has provided the market since the 2008-2009 financial crisis. And that's with a really good demand year last year. So OPEC is trying to get out of this, and it needs to figure out a way of doing that without crashing the oil price.
Just a few variables to consider, right?
Yeah, just a few. And like that was just, that's just like two or three. There's obviously many, many things going on in the oil market. That's why it's so fun.
Yeah. Can you outline what you would think would be both a bull and bear case for oil over the next 6 months?
Okay, so over the next 6 months, and I should say that I am tactically bullish right now on crude, mostly on a positioning basis. What you've seen is my general view for oil prices is that there is a fundamentally, fair value price of crude that's mostly determined by inventories and, as best as can be estimated, some kind of expectation of future kind of supply and demand dynamics. On top of that, you have a very cyclical, speculative kind of a hot money cycle that comes in and out of crude. Over the past year, that's been the primary driver of up cycles and down cycles. And everyone knows in these markets that, price drives narrative. So you have these bouts of euphoria and then depression. And as far as I see it on the fundamentally determined kind of price anchor, not a whole bunch has changed. That could deteriorate this year if China remains weak and, U.S. supply reaccelerates at all. Then you could have a situation. I think that's the bearish situation, because then you end up where OPEC can't ease its barrels easily into the market, and then pressure kind of begins to build within the cartel. The other thing that could go wrong there is that OPEC is supporting this market because it's trying to defend $80 to $90 barrel crude, which is much higher than the prices that it would have tried to defend historically. That is a discretionary choice by OPEC and particularly Saudi Arabia. They can choose to believe that that's no longer defendable, and then they could let the price drop. I think we're very much in an OPEC-driven market. For the bull case, I think the bull case is essentially OPEC's demand forecast. You have 2.25 million barrels a day of demand growth this year, 1.8 or so next year. That gives plenty of room for OPEC to ease back production. By the end of next year, under that scenario, you would have no real slack production left in OPEC's system. And then you just end up in this kind of back to the setting essentially of mid-2022, where people are expecting this kind of chronic bull run going forward if demand hasn't slowed down. But I think right at this exact moment, I would say we're leaning more towards the concerning kind of structural side of it of demand isn't really fast right now, and we need it to be much faster. And OPEC is looking for its avenue back in, for its barrels to get back into market, and is not immediately seeing it. For people that aren't aware, OPEC has announced that it is planning to begin easing its latest 2.2 million barrel a day cut tranche in October of this year, basically easing a bunch every month up until a year forward or the next September. Based on the outlooks from the IEA and the EIA, that would result, if fully carried out, in a very large supply surplus next year, and particularly by the end of the year. OPEC is more bullish, but I think that even if you take a midpoint, and the EIA is honestly pretty in the middle, I think that OPEC, if they want to defend this price or they want to get back some market share and prove to its membership that these aren't permanent cuts, I see them doing a partial easing, which I think will still put some pressure on crude prices, but I don't expect they're going to tank it, and that's because it's not in their interest.
Obviously, it's an election year. I am curious if the election has anything to do with what happens next to oil. Is there a sense of Trump is more bullish than Harris when it comes to oil prices? I mean, you probably saw the same headline. He's saying we got to replenish the SPR right now. Yeah. Let's talk through some scenario analysis here.
And if just to add on that, specifically like tariffs, like what do tariffs do to oil prices?
So let's start there for a second, just on the tariff side. I think if you followed through on tariffs, it would have like just purely and weirdly distortionary effects. You would obviously have more expensive imports. You would try and have some kind of prioritization of domestic use. You try and be exporting more product. There would be kind of weird flow changes. But I honestly, what we've seen in the past is that when there have been protectionist measures, particularly in the United States, and particularly like in my experience relative to Canada, there have usually been pretty explicit carve-outs for things like crude. So I would be shocked if I mean, I don't think Trump will follow through with a 10% tariff in any case, but if he did, and if they did something approaching that, I think there would be some kind of carve-outs for particularly politically sensitive things like crude, and particularly given the strength of that kind of trade lobby. But more broadly, I think that people often kind of overstate or overhype the importance of the U.S. presidential election for oil prices specifically, or particularly for U.S. production. Because really, I mean, the big bull bear narrative on the production side is that Trump will drill baby drill, and that'll drive the price down, and Harris will ban fracking nationally, and that will, shoot prices to $300 a barrel. Which, yeah, if they banned fracking nationally, yeah, I would be extraordinarily bullish. But I also don't think that that's going to happen. I think the most likely ways that the president, U.S. president, will affect the oil market is through things like security policy, things like sanctions policy. I think obviously last year, Iran was the second largest source of global supply growth at 800,000 barrels a day, second only to the United States. And again, really complicated OPEC's kind of at what were supposed to be temporary cuts that have become quasi-permanent. If Trump comes in, I think all else equal, the expectation is that you will see a drive down in Iranian exports again in production. Some of that, I think, will be sticky because I think, well, part of it is probably a Biden administration not enforcing those sanctions as hard as they possibly could. I think at the same time, Iranian crude marketers are just getting better at sanctions avoidance and finding buyers, particularly in China, that aren't sensitive to U.S. dollar sanctions in the same way. I think same thing can go for Venezuela. And then obviously, I think the final thing I'll mention here, and we had briefly talked about this in the preamble before we started recording, is the SPR. I think obviously everyone now that the SPR is a piece on the table. I think the expectation is, because people would always say historically that, the president is going to do something to purposely drive down the price of oil just ahead of the election. And now, because it's very politically sensitive, and now they have a direct tool for doing that in the Strategic Petroleum Reserve. I would say I do not expect any material moves out of the SPR ahead of the election. And in fact, what we've seen so far is that the Biden administration has almost expended all the funds it has to refill the SPR. As of I think it was last week, we heard that there was $1.2 billion left in the DOE's so-called petroleum account, which is essentially the pot of money that when they sell things, that money goes into, and when they want to buy new crude, they have to take it out of that account. Because so much of those funds out of that sale from 2022 and the end of 2021 were basically remitted to the Treasury for use by Congress. It was a trade for mandated sales. There isn't a ton left, so they can basically do about 15 million barrels a day more, 15 million barrels of more purchases for the SPR, and then they're out of money. And then Congress needs to recapitalize the account, which I think is a fight that should be started soon. I think it is in the interest to have money in the account, particularly if, let's say, the market falls apart and we really kind of drive prices down. That should be a strong buying opportunity for the SPR if markets do flip, for instance, back into contango.
You had said that it's overstated on the presidential side, right? As far as the impact on oil. What about the monetary side? I mean, how much does the Fed pivoting alter the dynamics for oil at all?
So I think, in the most straightforward way, higher rates are worse for demand. And in a moment where we need stronger demand growth to allow OPEC room back into the market, I think beginning to cut rates, or at least signaling to cut rates, is all else equal bullish for demand. So I think, that's like literally macro one-on-one answer, but that's about as far as I see it. I think that you do have periodic bouts of, risk off tantrums that take crude lower. But that, I think, it all gets folded into that spec cycle I was talking about earlier, that even if you have a big spec wipeout like we did with the Silicon Valley Bank crisis last year, and we had multiple times over the past 18 months. That kind of, you see a big puke from spec positions in the commitments of traders report, it bottoms, and then you get a big kind of surge of buying that follows. And I don't think those things are directionally driving, unless they really blew up the economy. If there was contagion and economic harm and then that slowed demand, yeah, for sure. But I think, just as I think what we're seeing right now, kind of Volmageddon type sell-offs, I think these are temporary things, and whatever selling happens in crude because of them will inevitably just revert to buying on the other side.
So I know you want to stick to the commodity space specifically, but just a comment on commodity equities. What is break-even rates in the US look like, right? At what point of, like, on the downside of oil does it really start jeopardizing what is considered to be these very strong free cash flow businesses, et cetera? So,
yeah, I think that you have seen inflation throughout the entire system relative to pre-COVID. I think you saw that in labor, you saw that in things like pipe, where I think the prices have come down, but the backlogs are still huge. There were strains, and I think that was a big part of the thesis, of the big bull thesis in 2022, was both that OPEC wasn't keeping up with its production cuts, US shale was stalling out because of production kind of supply chain issues, despite $100+ crude. But I think last year dispelled a lot of those as like a really kind of structural ceiling, and they grew even faster with lower oil prices. I would say that I haven't done a really detailed kind of equity level analysis to kind of give you like true profitability at a enterprise level. But I think when you're looking at these, I think most of these wells now are probably still requiring 70 plus 65 plus WTI to break even, at least on a project level. And below that, you're going to get contraction. I think when people always talk about like, is peak shale here? Is this the year that the US production really peaks? And one, I would say that it has to be a price dependent conversation, because a lot of people talk about it as if it's, geologic destiny or path dependence, that there is that the geology is fate. And when you run out of good drilling locations, you're going to peak. Geology is part of it, but geology and like commercializable geology is a function of the price. So I think that US crude production will continue growing at, $80 to $90 Brent. I think it's going to grow really fast above $100. But I think below 80 into the 70s, I think, yeah, you're going to get a stall out, and below that, you're going to get traction. I think we're starting to kind of tease out that true sensitivity without the pre-COVID norm of like total capital destruction. In the decade prior to COVID, you had $500 billion of investor capital burned in the US shale patch. I don't think we're going to go back to that stage of growth at all costs. But so far the prices are still supportive, and that's the challenge for OPEC.
Let's talk about speculation for a bit. I've seen some interesting charts around the amount of short interest in oil and also on the energy sector side from an underperformance perspective. Do we have a sense of how much of the current price of oil is being driven by speculators versus hedgers?
It's hard. I think that one, you're seeing less hedging now than you used to. One of the things through COVID is a lot of the companies that used to hedge in the US shale patch really aren't hedging as much anymore. So you're seeing that side of the market begin to dry out. At the same time, you've seen an explosion of kind of CTA and other kind of managed money speculative participants that are putting a lot more money into, technical momentum driven strategies that kind of blend pure quant with some kind of market metrics. But a lot of it is based around things like the momentum of calendar spreads is a classic trading signal. So you throw a momentum indicator based on a calendar spread, and you're buying when it's positive and you're selling when it's negative. So you get these big, if you look at the chart, I publish a Oil Context Weekly every Friday, and I publish it basically 30 minutes after the commitments of traders report comes out, because that for me is, while it is a lag data point, it's only 3 days lagged and gives you a really good sense of a texture to the current price. I think price is everything. I think people will delude themselves for years into thinking that their fundamental model is right and the price is always wrong. If the price is always wrong, your model's wrong. But I think getting a sense of what's driving the price in every moment, I think there's differences between structural and cyclical drivers. And I think that's kind of what I was talking about earlier, that you basically just have this big loop up and down. It's, goes every, month, 2 months, 3 months. And right now we're, or at least at the beginning of the week, we were really at the bottom of that cycle, near the levels we saw back at the beginning, at the beginning of June, when we had that big sell-off following the OPEC meeting, and around the levels we saw last December, when we also had a big kind of spec-driven sell-off. Part of this is, I think it's always a bit hard to tease out purely speculative versus purely fundamental, because what the spec is selling on is the selling pressure. Like, that's the signal that's driving it. But there often is some little bit of fundamental kind of spark that starts that movement in one direction or the other. And I think what we saw in crude markets, 3-4 weeks ago, was we saw really, really strong backwardation that had a lot of people really bullish. And backwardation, for those that aren't aware, is essentially a downward sloping futures curve from your point forward, which means there's a premium on prompt barrels or commodity or whatever, and is a bullish signal, because I think the calendar spreads and the futures curve gives you a sense of the future based on today. And today is tight if it's backwardated. So we saw really steep backwardation, and a lot of people were really bullish, but it rolled over very quickly. And I think that was the signal that got everything else selling. And then it became a bit of a self-fulfilling kind of spiral down that brought us as low as, on Monday, we got down almost to $75 Brent, which is, that's the lowest it's been in a long time. I think fair value for crude right now is probably low 80s. I think that spec cycle, I see it as kind of like plus or minus $5 on either side. Like, the other thing that people, back in, there were weird instances like back in 2008 where people got in their mind that you could have these structural bull runs driven on speculation. And I just don't think that's how the crude market works. It's a fundamental commodity. It needs to clear in the spot market. So you can get intra-month or even month-to-month kind of big deviations in flat price driven by spec cycles. But I don't think they can fundamentally drive the curve for a long period of time. I don't think they can fundamentally drive the price materially outside of its kind of its fair market trend more than $10 at the absolute most.
So I don't want to talk specifically on lithium and the EV market, but you must be aware of this market because it obviously affects oil prices.
Yeah.
Anecdotally, what are your thoughts on where we are in the EV cycle, China EV cycle? Obviously, tariffs come into play with that, lithium prices, etc.
Yeah. So, as you know, my main look at the EV market beyond just natural personal interest, because I think it's quite interesting, is through a view of demand displacement, particularly in the gasoline market. In China, this ship is sailing really fast. It's wild. I think I saw a chart this morning that now more than 50% of sales in China are EVs, and that 98% of people believe their next vehicle will be an EV, which is just a staggeringly high number. That is like a fait accompli. For China, that ship is sailing very quickly, and for a bunch of reasons. Beijing has, long before EVs even, had a strong incentive to figure out ways to reduce their dependence on. They are now the largest importer of liquids by far. That is a strategic vulnerability for them, and they really don't like that. So even beyond, for them, EVs powered by coal, perfectly fine solution. They don't care. They just don't want the liquids dependence. That isn't happening as quickly or as kind of, in a pronounced way in North America in particular. Whereas that same poll that I saw was 98% for next car in China is EV. It's more like sub 50% in North America. Whereas you do have much more of a changing narrative towards things like plug-in hybrids, et cetera. And I think that's so. Sorry, you were gonna say?
Yeah. What do you attribute that to? Is that lack of charging stations? That's a pretty divergent expectation in the future between two countries that you would expect would have pretty similar numbers, or at least I would. But
yeah, I think that part of it is in North America in particular, everything is really far away. The government built out infrastructure on the charging side is not particularly good. I recently was back in my hometown for Canada Day, and our car died, and I ended up borrowing my grandfather's new plug-in hybrid, and I'd never actually driven one before. And honestly, great ride, super cool. If I had a house with a charging plug there, I could see myself. I definitely think I'm going to go this direction. It's really cool. Charging it, not having a home charger was absolutely torturous. Trying to find a place that was convenient, that wasn't broken. It charges even the level 2s immensely slow. Like I would say, like that side, we just need to figure out. And I think that North Americans are, when it comes to mobility and kind of freedom, are kind of pampered in a way. Like we really like our big cars and our big gas tanks. We like to be able to go 800 to 1,000 kilometers on a single tank. That is something that EVs cannot yet reliably do. And that's just more important to the North American consumer, which is interesting because I think if you looked back a decade ago, even, the expectation was that Europe and North America would go up the EV curve first. And that lower developed countries, because it was going to be more expensive, were going to take longer to catch up. And you're actually seeing in many ways the inverse happening, that countries that are building up their automobile fleets fastest or have a reason to displace liquid fuels like China are going a government-focused kind of build it out and just blitz it. And so I think one thing I will say, though, about this interview about China, even though the EVs are quickly taking over market share, we haven't actually yet seen a market impact on gasoline demand in China. In fact, gasoline demand is actually one of the strongest single fuel segments within the overall barrel. Interestingly, what you're actually seeing drive weakness in China is something that we had always assumed, myself included, was being much safer structurally long-term, which is diesel demand. And you're seeing a big displacement, not by EVs and diesel, but by LNG and trucking, interestingly enough, which is something that I've seen talked about, but the Chinese distributors have really aggressively built this out. They've been helped by the glut of LNG and the cheap prices we're facing right now. And they've put, it's something like almost like 500,000 barrels a day of diesel demand is currently estimated to be displaced by LNG trucking, which is just that combined with renewable diesel penetration in California has meant that diesel demand has actually been quite weak, where it has been a source of strength through most of the pandemic and had been a source of like go forward confidence in demand because it was going to be more resilient to things like EVs. And that's why, while the gasoline curve remains backwardated, the diesel curve has been in deep contango now for months.
You can't just talk about like gas cars and just or natural gas cars and then just pass over it. Tell us a little bit more. These like these feel like little bombs driving around the street. That sounds like
so this is yeah. This is specifically in long haul trucking. And I would say I'm still trying to find more information on it as well. But the reports I have read by a couple domestic Chinese consultancies and some of the good trade journals like Platts and S&P have done some coverage on this and have showed that on like a per mile basis, given current LNG landed prices in China, it's actually cheaper to run these things on LNG. So they've been building out refueling terminals. The estimate I saw, which is again, I still need to validate all this because the numbers seem way too big, way too quickly. That something like half of LNG demand in China right now is in the transportation sector, which is bizarre and something that I've never even built that into an expectation. So I would say that right now, I wrote a piece on Chinese demand week, and that's about 3 weeks ago. And that was the biggest surprise in the entire piece. Gasoline and jet fuel doing really well. Consumers in China seem to be really strong. I think we have a lot of reasons to be dour on industry in China, real estate turned down, everything else, but it's actually more direct fuel on fuel competition, not a macro drag that seems to be the biggest single inhibitor in China right now, which was an unexpected result when I started digging deeper.
Rory, we're at the top of the show here. Explain how people can learn more about you and your research, and what do they really get when they sign up to your service?
Yeah, well, thanks so much for having me on, guys. This is a very, very fun conversation. You can find all of my research at commoditycontext.com. I publish on Substack. I publish typically twice a week. I have a bunch of monthly data heavy reports that I put out. I do a lot of my own modeling and my own data collection and kind of accounting. I have Oil Context Weekly, which I publish every Friday. Big wrap of the oil market, 4 p.m. around there Eastern every Friday. And then I also do a bunch of thematic and kind of more my favorite work, which is like really digging deep into a topic like Chinese demand weakness or I published this morning a piece on like really trying to get a sense of how big China's OPEC's current production cuts are. Just trying to add context, if you will, to this. I think everyone comes out in this sector with a really strong view. I think too few focus on really trying to understand that data context of where we're currently sitting, or very recent history at the very least.
Everybody, please make sure you check out commoditycontext.com. I appreciate those that watch. Again, this is on behalf of the ETF think tank at Title Financial Group. If any of you want to learn about launching an ETF, go to titlefg.com. And special thanks to Rory Johnston here and my friend, Mr. David Chikansky. We'll see you on the next episode. Thank you, everybody.